think the first thing today is to congratulate Christian, because the conference this year is just amazing. The participants, the audience, and the organization, of course. So thank you very much, Christian. So I'm going to give a very brief speech of what we do in Valentum. We created the fund 3 years ago. And as Christian said, I mean, we look into free cash flow yields with low levels of debt, so high free cash flow yields on enterprise value at the end of the day, with a good management team, with skin in the game. That's what we look for, and of course, as high as possible returns on capital employed. But at the same time, we look for something else. The name Valentum is the mix of value and momentum, right? And for us, momentum is the search of catalysts that can make that value trigger the stock as quick as possible. And for us, momentum at the end of the day is always improvement in results. Improvement in results because of the stage of the company or the sector, but more in specific terms of the company and what management can do. A restructuring, a cost-cutting, change in the business strategy, things that we can touch and feel, and that we can see that management can do something to improve the results in the relatively short term, though with impact in the long term and in the long-term valuation of the company. This is us. Luis, my partner, is back there somewhere. And myself, we were sell-side analysts for 10 years here in Spain, covering small caps and, well, a few blue chips as well. And we decided to set up the fund. We set it up in Jesús. If you're able to pronounce this name correctly, I might invite you to lunch or something. Independent asset management company, and great with them. This is the performance of the fund in the last 3 years, and this is our portfolio. We publish this on a monthly basis. It's open in our website, in our monthly letter, so if you're curious, you can go to valentum.es and check them. And just write us an email and we can add you to our mailing list if you want. So today we're going to talk about a German company. It's called Publity. What they do is a real estate manager. Well, it's an asset manager of real estate funds. Okay, so basically they do two things. The first one is real estate funds, and here they got three types of funds. Institutional joint ventures. This is an institution that comes and wants to set up a fund with them. They set up a specific vehicle. Then the closed-end retail funds, they started with those. And now they are listing a REIT. And the other thing is they manage MPLs, basically the funds buy the MPLs, or they manage them for the Landesbanks. So what do they do exactly, and how do they do it? They basically have a good franchise or a good acquisition power that they can buy at distressed prices. And they are very quick doing the due diligence and putting the money. Then they manage the asset. Basically, they try to increase occupancy. They try to renegotiate some things to improve the value of the asset. And finally, they sell it. I mean, this is not a buy and hold type of fund. They like rotating the assets in around 2 or 3 years. Okay? This company started with the CEO, who is Thomas Oleg. We'll talk about him in a while. He used to work with the Landesbanks, and he saw the opportunity. He started to see the opportunity with MPLs, to buying MPLs or managing the MPLs and retaining a fee. And after that, he went more into real estate. And what happened? In 2015, this was a very small company. And in 2015, a big US investor came to them and told them, we want to invest with you. We want to set up a fund for you to manage, but we need you to co-invest with us. And these guys, they had no money. I mean, they were the managers. It's the same business as our business. I mean, they charge a fee and they manage the fund. So they decided to go public and to raise 30 million. The investor was putting 1 billion and they required a 3% co-investment of Publity. And well, this is 2016 is more 2017. They are launching now the REIT that would be listed in the next few weeks in the German stock exchange. So the company can be divided into 3 large types of funds. The first one is the small ones, the retail funds with which they started. They manage around 200 million only here, and they buy assets of between, well, up to 10 million. Then the blue one is the REIT that will start trading, that will be listed in a couple of weeks, and they want to buy assets between 10 and 25 million there, and they are targeting a 1 billion assets under management there. To start with, they will start with around 100 million. And then the big part, the institutional investors, 2.5 billion of assets under management and assets of more than 25 million. What do they charge? Well, here in the small retail funds, it's quite expensive. An initial fee of 3% to set up the fund, the structure, the marketing, whatever, and a 2% management fee. The good thing, and before you ask me, yes, this is very expensive, I do believe so, but they're not going to grow in this. I mean, they started with this, and these are the funds that they've got, but we're not looking into growth in this part. The REIT will charge a 1% management fee and a 1% acquisition fee of each asset. And here, the institutional size of the institutional funds, of course, you expect a lower management fee with a performance fee and an acquisition fee. Okay, with this, and then we only have left the MPLs, which basically what they do is they get the MPLs, they try to recover as much as possible, and they charge and they stay with 22% of the recovered assets. They talk about 2.4 billion of assets, but this is, I believe this is more or less the pipeline that they've got, not the real assets that they are managing on a day-to-day basis, because at the end of the day, the MPLs is quite a small business for them right now. So this is the summary of the fees that I just told you. Consus is the REIT, and one thing is that they only buy assets, commercial property, offices, okay? That's what they know how to do. Okay, this is the evolution of assets under management of the company. As you see, in 2011, they had 30 to 32 million, more or less what we've got in Valentum, so hopefully in 7 years we'll be up there. No. And as you see here, in 2015 is when the institutional guys came, and there has been an upgrade. The good thing, this is Thomas Olek, the CEO and founder and main shareholder, and he said in 2015 that by the end of 17 he would have 5 billion. I mean, now that guidance is not only reinstated, but they say that it might be a bit more of 5 billion. So he's really confident in what he's doing. He knows the investors, the clients, and we feel quite comfortable with him in terms of managing the company. Well, this is more or less what I told you. They've got access to discount prices. They do a very quick due diligence, and they've got the money, okay? And they've got a pipeline. We'll talk about that in a while. Good thing of them. They are, you can argue that they might be a bit bullish with this evolution and what they expect to continue having, but they know something. And what they know is what they can do, and they know what they can't. So they know that they know the German market. They know that they know the commercial real estate market, buildings, clients, and situation. They know there are cities where they cannot invest, or they don't want to invest, where they are overcrowded or prices are a bit of a bubble, like Berlin. And they know that they don't have a clue of the sector outside Germany, okay? So this gives us confidence because they're not going to go crazy, getting out of Germany and going around Europe. And what they also said is, this is a company of between 8 and 10 billion euros of assets under management, okay? So there's still a significant growth to capture, but they're not going to go crazy, and we believe that they're not going to fail due to a very quick and crazy growth. The two strengths in our view are, what am I doing? The CEO, which is the guy who set up the company, who has the contacts, and who knows the market, well, and the management team, of course. But he's the guy who set up everything and that has the real contacts. And then institutional investors. Why? Because these two things are the key to buy cheap, to buy assets cheap. One, you need the contacts in the Landesbanks, and two, well, you need also to do the due diligence very quick, but you need, when you set up a price, you need to be able to pay really quick, and the banks know it. And then banks know that when they make an offer, that they pay really quick because they've got the assets, the money. So this is a differentiation from peers. CEO, many years in the sector, especially the CFO, also coming from banks, knowing the sector and knowing what doors to call to get the assets, and a management team which is based in the different processes of the company, acquisition, management, and sale, and very few people, okay? Costs, very low. These guys are based in Leipzig. This is the Eastern German part. It's a 500,000 people city. Salaries are low, the cost base is really low, and they externalize absolutely everything. Everything. They just want to get a good price, entry price, a good exit price, and they want to improve the rentals and the cash flows of the assets. So for that, they need very few people. As I said, the guy has a lot of skin in the game, 58%, and there's a convertible bond. We'll talk in a minute, and he owns some of the convertible bond as well. And of course, you might have guessed, this is a small company. It has a market cap of around 230 million. Average daily volume, it's around a bit more than €500,000. It's only covered by one bank. The analyst is positive, but when you talk to him, like, he's not really pushing the idea, I would say. And then the company, they don't care about institutional investors. I mean, we were in Leipzig 2 weeks ago. It was an interesting trip from Madrid, because Leipzig is, sorry if someone is from Leipzig, but it's in the middle of nowhere, and difficult to get there. And these guys, they decided to go public because they needed the money to co-invest. But for them, the important shareholder is the retail shareholder. Why? Because the closed-end retail funds, those guys, the guys that invested there, many of them are now shareholders of Publity. And they've got between 9,000 and 10,000 retail shareholders. They pay a dividend. They think that the retail shareholder likes the dividend, and they are happy how they are. They don't need more coverage. They don't need to speak to institutional investors. So, and they've got the big institutional investors giving them business, which is important for them. So this is good for us because it's an uncovered stock. It's a very unknown stock, and we've got an opportunity here, I think. So, a few numbers to give you a better grasp and a better feel of what they are doing. Okay, we start with assets under management, and we get down to a level of revenues with the management fees that I talked about. We have to take into account two things. In the first few years, when they set up a fund, they've got more revenues because every time they buy an asset, they charge an acquisition fee. And let's say in the second part of the life of the fund, they would start having the performance fees, especially talking institutional investors, which is a large part of the company. And again, acquisition fees, because when you sell a property, you will start buying another one, okay? So we've done here what we think it could be in the next couple of years. We don't like doing great estimates. And we've done, the last column is with the level of assets under management that they think they can manage, between 8 and 10, we go to the lower part of the range, what would be the revenues and the net income with only the management fee, okay? Assuming no acquisition fee and no performance fee. To be more conservative, it's just to give you an idea, or look at numbers in different ways. So the blue lines down here, net income here is free cash flow, no assets, no capex, nothing, 2 computers. So that's free cash flow, and you can see the yields here. There's a very important thing here to note. These guys went public in 2015 at around 32 euro per share. They're now trading at around 36. Not much has happened. It went down, it went up, it went down again, it went up again, but nothing much. But if you see in assets under management, things have changed a lot. And in net income, cash flow, EBITDA, revenues, things have changed a lot. And they are gaining new institutional investors. I mean, the story is improving, is growing, is changing. But the valuation hasn't, okay? So that's what we really like about this company. As I said, they pay dividends because they don't have assets to invest in, because it's low capital intensive company. So they pay the dividend because the retail shareholder as well likes it, and because Mr. Oleg, I guess, also likes it. As I said, very clean balance sheet. They've got 30 million in convertible bonds for the co-investment, because they issued the first 30 million as capital to go public, and then they issued another 30 million in convertible bonds because they had another billion of another institutional investor that required them to co-invest. So they said, we're not going to increase capital right now, let's do a convertible bond. So here you see the dark blue square goes nearly up to 60 million. That's the investment in vehicles that they've got, and financed 30 million with capital, and another 30 million with bonds, an extra cash, a little bit of cash that they've got. So very clean. What are the risks? Well, basically here the risk is Germany and the real estate in Germany. You might say prices are high, prices are low, there's more stock or less stock in the Landesbanks. Here what they say is that the Landesbanks have a very, very large pipeline. They've identified 1 billion to buy in the short term, but they say that the pipeline is really huge. In NPLs, well, I guess as well, this could be more business as usual, but again, we're not really focused in the NPLs business. Interest rates, if interest rates rise, the yield compression, or the difference between what they can get and the interest rates, well, that's a slight risk. And of course, we think that the people, if something happens to Mr. Oleg, well, that could be a problem. And if the people they've got leave the company to go to a better paid salary, that would be a risk. The good thing here, we believe, is that they can grow without growing a lot in number of people. So if they have to pay more, they can pay a lot more. If you saw in the P&L that I mentioned, the personal expenses were very low compared to revenues and margins and net income. Client concentration definitely is a risk, because we think that the 2.5 billion of institutional investors is concentrated in around maybe 3 or 4 investors. It's true that they've got a lockup of 5 years since the moment they decide to exit. But at the same time, if you decide to exit, you're not going to exit today, but every asset that you sell, it's not going to be reinvested. So the company would start going down slowly. And of course, you need a good track record. I mean, we all know that. If we've got bad track records, our clients will leave as well. So that's crystal clear. There are not many true peers here because it's an asset manager. There's a company in Germany called Patricia Immobilien, which is trading at 20 times PE. And basically, they do something similar. They manage funds, but this is more a story of a buy and hold, okay? And much bigger. They had problems in the past, and they turned from a capital-intensive company to an asset manager. And then asset managers, if you look to asset managers around the world of different kind of things, they trade between 10 and 15 times PE. So here, how much can this be worth? In our opinion, we've got a lot of cash flow, a lot of dividend, which, well, we're not great lovers of dividend, but here, I mean, there's nothing to do with the money. So dividend, sound balance sheet, there's growth momentum right now, which is important. Clients have a lockup, so in the next 3-4 years, we can be, I think, okay with that. And Thomas has skin in the game, no? So what we've done is two things. A very easy, straightforward thing is say, okay, let's go to the bottom part of the range of the valuation of asset managers, 10 times PE, fully diluted, assuming the conversion of the convertible bonds that will definitely happen in 2020, and we get 59 euro per share. I mean, this is straightforward. And then we've done another exercise, okay? This is an exercise just to understand the numbers and how they can work out. It's not, I mean, I wouldn't take this as a real valuation, okay? We basically got the net income, the estimates that we did in the previous slide, and we discounted, well, I had another slide discounting it at 10%, and more or less the discounted cash flows were around 200 million. And if you get a terminal value, of course, it would be an implied PE 2017 of 15 times. You know that 2018 net income is going to be higher, so we're quite comfortable with this. And one more thing you have to take into account, the 60 million, okay? We're doing this valuation fully diluted. We're not including the 30 million of capital that they got in the IPO, and we're not including those other 30 million that will be converted into shares, and that's invested in assets, in real estate assets in the funds. So you should add another 60 million, okay? So for us, it's a very nice idea because it's uncovered, it's small, but you can buy. I mean, we haven't had much difficulty buying, and we see, I mean, we can very well and very comfortably see the cash flows in the next couple of years. And it's the cheap, things have improved in the last year, and the stock price hasn't, so we like it very much. The catalysts, as I said, we look for catalysts. We believe that the announcement of new joint ventures with institutional investors will be important, and this is something that's definitely going to happen, because if they're going to reach the 5 billion in 2017, and they're very comfortable with that number, because they've got already some institutional investors that are getting in right now. The listing of Consus and the growth of Consus, I think that would be a very good catalyst. And finally, all this reflected in quarterly results with the company growing and generated cash flow. And I put here, if in English, better. Okay, this is not only a company that's small and covered and known and that don't care about institutional investors. It's a company that if you go to their website, you have the English version, but then if you start clicking into things in the English version, it drives you back again into German. So you've got the 2016 half-year results in English, the 2015 full-year results only in German, things in German, a couple of things in English. I mean, you would say this is a mess. So that's why we went there to see if the company exists. There's somebody here that knows the company, that knows somebody that's worked for the company, that has done business with the company, so we know that the company actually has business and is buying things. So we're quite comfortable, and we think it's a great idea for a value investor. So these are our contact details. If you want more to talk further, or if you want to ask questions, please go ahead.
Thank you, Jesús. I don't know what you say about German. It's such an easy language.
Hello, Jesús. Thank you for your presentation. I would like to know, when you talked to the only analyst that covered this stock, the reasons why he particularly wasn't pushing this idea.
Good question, because, well, we had this feeling that he wasn't pushing it, and we asked him, but hey, mate, This is really cheap. Why aren't you pushing it? Well, yes, no, yeah, it's cheap, but I don't know, yeah, no, yeah. What? You like it or you don't? I don't know, maybe because it's small, maybe because not many people are interested. I don't know what, but he's got a positive rating and he's positive when you ask him, but then, I don't know if it's him, because I don't know him very well, or what's the story there.
Hi, thank you for the presentation. I'm wondering, as the company grows from the current size to the 8 billion, do you think they will need to issue additional shares in the same way that the institutional investors have required additional capital? Will they have to issue additional shares, and how does that impact your dilution effect going forward?
What they said is that for now, the new business that they're getting from new institutional investors, that they are not requiring them to co-invest. But we definitely think that if institutional investors are the key for the growth of this company, that they might need more capital. So we asked them, maybe you shouldn't pay so much dividend and keep some cash to co-invest. And they said, well, yes, we actually are keeping some more cash in the company. And there's one thing that they said here. They pay now around a 64% payout ratio. And they said that, I don't know why, we end up talking about 4 euro per share of dividend. And they said that could be a sustainable level, not to go beyond that. So I don't know if they've got something in their heads going forward because there could be more co-investment, and they said that if they needed co-investment, that probably the solution would be convertible bonds, not a straightaway capital increase. But yeah, definitely is an issue. And one thing that he said is, look, I'm not investing in real estate, my money. So I don't want to keep that cash flow in the company to invest it then in real estate. If somebody tells me that I have to co-invest, I will. But otherwise, my business is the asset management, the fees. So, well, interesting. Yeah, aquí, Cristian.
Thank you, Jesús, for the idea. Two questions.
Espera, que te traen el micrófono.
So, what is their track record? What do they sell? What kind of returns they sell to investors? And the second question is about this is a people business. So, what is their incentive? Not from the founder, but from the other team. Do they have stock options? Do they have some sort of management incentive plan, etc.?
The track record, they gave us a figure, I think it's somewhere here in the presentation, of around 20-something% in 18 months. I think they gave that figure because it's from when they started with institutional investors. We have a feeling that maybe the closed-end retail funds didn't have that good of a track record, but the thing here is that if institutional investors have gone in and the due diligence, of course, we guess, has been deep, they must have a deep knowledge. By the way, they told us that the institutional investors, I mean, this is like an open secret. They don't say it, but they say it is Elliott Fund. So that's another plus. And then regarding the incentive fee, the guy that's going to manage Consus, the REIT, he's going to have shares of the REIT. And that's a question that I don't know how to explain this. I mean, we think that the guy knows about his business a lot, that he's very good. We don't know if the thing is that he's gone too rich too quick. He likes money, and he knows he likes to show that he has money. And maybe there's a bit of a difference there between what he's getting and what management is getting. At the end of the day, they are spending like around 4 million in payrolls. And they are very few people, 15, 20. I mean, salaries for Leipzig won't be that bad. And I guess that if they grow, they will increase the salaries. But they didn't mention, and they've never talked about, stock options or whatever that, in our opinion, would be very good to retain management. Absolutely. Okay. Thank you very much. Nice.